A big next step for small business owners is the question of whether they should incorporate or not. In this video, I'm going to take you through the decision tree so you can decide whether a meeting with your accountant should be on the horizon. But first, to get tips like this and many more for running your small business, make sure you subscribe to our channel and hit that notification bell. You can also sign up to our video email list for hot off the press news and tips. This video is directed at Canadian viewers as the rules are different for other countries and I only know the Canadian rules. So first off, what the heck does it mean to incorporate your business anyway? Well, at its core, it means you are transferring your business into a new legal entity that is separate from you. In return for this, you receive shares of the ownership in this new entity. You own it, but it's not you. It's its own legal person that can enter into contracts, obtain debt, have its own bank accounts and credit cards. It can get sued, it can go bankrupt, all that fun stuff. So why then would a small business owner want to incorporate? There's a host of reasons, but I'll break it down into the biggest reasons. Incorporating your business can bring an element of protection to the business owner in the event that its business suffers a financial blow so hard that it can't recover, such as damages arising from a civil lawsuit or bankruptcy. Business owners can find this an attractive way to protect their personal assets, such as their houses and personal savings. Remember, while the small business owner may be the owner of the company, there is a legal separation between her and her company. Now, while this all sounds like some good disaster planning, here's the thing. Most business owners should weigh the benefits and costs of this before making a decision to incorporate solely on their desire to protect themselves. Remember, you're going to want to insure your business against liability anyway, and in some cases, you can get policies underwritten for $1 to $2 million in most run-of-the-mill businesses. You may want to ask yourself, how litigious is your industry? Remember, it costs money to incorporate, like thousands if you do it right, and annually there's administration costs as well, so make sure you don't just jump too quickly into this and bring a gun to a knife fight. The other thing to consider when contemplating your risk threshold is this. If your small business corporation ever requires bank financing, most banks are going to require the corporate small business owner to sign a personal guarantee anyways, which puts the owner on the hook personally in the event their business becomes insolvent. And it's pretty normal for business owners to sign these. Hey, small business ownership is not for the faint-hearted. So since this is primarily a tax-motivated transaction, it's important that you understand two key concepts in the tax minimization game. First, deferring tax means putting off payment to some time in the future. It doesn't get rid of the obligation, but here's why savvy tax minimizers like it. First off, if you don't have to send tax money off to the government today, we can use that same money to work for us and hopefully create income or help finance our growing businesses. You could think of a deferral as the best interest-free loan you could ever hope for. And in a weird way, it comes from the government. A dollar that we're able to save today is worth more than a dollar in the future. Tax avoidance is when we can actually get out of paying tax altogether. Yep, it does exist, and I'll explain a little later. So, the number one reason by far for incorporating your small business is tax driven. And of course, deferring and avoiding tax is the main reason folks incorporate their small business. Let's talk about tax deferral within the concept of incorporation. Think of it this way. Here's how tax is different for an incorporated company than that of a sole proprietor. As a sole proprietor, taxes work this way. You earn revenue, you deduct business expenses to get your net income of the business, and then you report 100% of that income on your personal tax return, of which you will pay taxes on at whatever tax bracket the income falls under, regardless of the amount you've actually drawn from the business. Now, this isn't a big deal if you're drawing out everything you're bringing in, but what if your business is making more money than you actually need to fund your personal expenses? And I know for some people this may not ever seem like a problem they'll get to, but hopefully they will, and when they do, ask yourself this. Doesn't it suck that even though I don't need the money right now that my small business has generated, I have to send away a bunch of tax to the government? Well, what's the alternative? Incorporate. Okay, here's how tax works for incorporated business owners. The company generates revenue and deducts business expenses to get a net income that it will pay corporate tax that is significantly lower than the personal tax rates at certain higher levels. The owner will make up the difference when she draws out the income she needs to fund her personal expenses. So there's really no benefit to earning the money personally versus corporately yet, or at least at the time that I screened this video. But here's where it gets really sexy. The money she didn't need to draw out only incurred a relatively low tax rate, and the after-tax money can sit in the company in a tax-deferred manner. That money can be used to grow the small business, or it can be put to work in other ways. But it's important that a CPA is involved if you want to put the money to work in other ways other than reinvesting back into your business. Things such as rental properties, portfolio of investments, or even just leaving it in a bank account can cause possible problems down the road, and your CPA will likely have a bit more of an elaborate structure that they'll want to put in place if these passive types of assets get on the higher side. So again, if you don't have a CPA in the mix, what gives, man? In a nutshell, if your business is making more money than you need to live, time to go see your accountant. So let's talk about how we can actually avoid taxes by incorporating. A couple ways. First, it exists in a tax shelter called the capital gains exemption. This is a lifetime exemption that is available to every Canadian resident who sells shares in a qualified small business corporation. The details of what qualify are in-depth enough that I will cover this in another video, but in a nutshell, this exemption can be used to reduce the capital gains on the eventual sale of those shares. This is a substantial exemption. I mean, we're talking a celebration of epic proportions if you're able to take advantage. But a big warning, this isn't a do-it-yourself endeavor if you hope to someday take advantage of this. It's very important that you have a CPA take care of you every year to ensure there are no surprises when it's time to sell. Now here's the other way we can get avoidance. Tax deferral can sometimes turn into avoidance. So remember those excess assets your company's producing that didn't need to fund personal expenditures? Well, someday, depending on a whole bunch of variables, you may find yourself in a lower tax bracket than when you were during your productive career. Now think about it. When we're younger, we have mortgage payments, diapers, formula, daycare, and then with teenagers you have a huge grocery bill, and then university, not to mention all the toys and trips you may have spent along the way. But when we retire, a lot of those expenses are eliminated or reduced. Our financial needs are generally not as demanding as our earlier years. You know, we start to eat like birds. Therefore, when we draw down on the savings we accumulated in our corporate structures, we are possibly doing so in a lower tax bracket. It's not always the case, but we definitely get more flexibility and more control around our tax situation within the incorporated world. There are some other things we can manage with incorporation, such as repurposing funds away from the Canada Pension Plan into our investment plan. But some of the stuff gets pretty nitty-gritty, and there's things that your accountant can go over with you. Now here's some common questions I get when people are considering incorporating their business. One is, do I get credit for all the capital assets and inventory, etc., that I purchased as a sole proprietor that will be rolled into the company? And the answer is, you get full credit. What about outstanding business loans? Do they get rolled into the company? Well, possibly and preferably yes, but this is something that needs to be communicated and managed between you and your CPA, lawyer, and creditor. Sometimes newly incorporating small businesses can have a hard time getting access to credit right away out of the gate, but not always, but sometimes. So it's not the end of the world because you can continue to use credit cards or lines of credit that you had personally, and your CPA will just make sure that proper accounting happens for these scenarios. I often get asked if there are additional expenses that can be claimed as a corporation, and for the most part, really not much changes in this regard. It's important to keep a good set of books, maybe even a little more important, but all the rules that apply to a sole prop versus an incorporated business are the same. People often have questions about the cost of incorporating a sole proprietorship or partnership, as well as the annual cost. And I'm not going to lie, setup ain't cheap, and your annual costs for tax preparation are going to be more. And I don't mind talking with you offline about this, but remember, a good CPA will crunch the numbers Make sure that going forward with an incorporation is a good investment, depending on the specifics of your scenario. What you never want to do, and I'm going to be absolutely blunt here, never try to do this yourself or on the cheap. Incorporating an existing business is a highly complex process. It requires careful coordination with your lawyer on the steps for setting the company up, the purchase and sale agreement, the specific clauses that need to be in place, as well as the numerous CRA filings that need to be completed. This is a delicate process that, if not done properly, can result in a hefty tax bill in the future. I'm not trying to scare you here, but too many times I've gotten new clients that have a mess of things because they went ahead and did it themselves through one of those online services. Stay away. A CPA well-versed in the public accounting industry should lead this process. Good lawyers often will not proceed without instruction from a CPA firm. But sometimes lawyers who not well versed in corporate work like this will go ahead and incorporate you without a CPA in the mix. And this can be just as dangerous as doing it yourself. So just be careful, and when in doubt, make sure you have a good CPA in your life that helps you through these big milestones. Like I always say, keep your friends close, but your accountant closer. That's it. If you want to chat with me, I'll put a link in the notes so you can book a Zoom call. Take care.